Hey, if you're looking to create a set of financial projections for a pressure washing business, then you have come to the right place because we have built a financial projection template built specifically for a pressure washing business. And I'm going to walk you through how to fill out this template, how to get it ready to present to potential SBA lenders or potential investors, and really just walk you through it step by step. Now, this particular template is kind of unique because we're going to actually give you access to two different templates, or two different variations of the same template, I should say, a single unit location and a multi-unit location. So let's imagine you start a pressure washing business in your city and things go well and you want to expand to another city or another market. This template structure allows you to kind of build in opening new locations over a period of time and kind of consolidating all that together to kind of show, hey, what would the financial model look like if you built out your pressure washing empire with multiple locations over time. So I am going to focus most of my attention here on showing you how to fill out that single unit location, because I think that's going to be most important, as most folks are going to be just getting started, probably looking for that first, maybe SBA loan or first investor to help cover some of the startup costs. And what those lenders and investors are going to be most interested in is making sure the first unit works. So let's make sure the financial model for the first unit works, and we can talk about expanding later is kind of the idea. So I'm going to focus my attention there. I put a link in the description of the video below to this template so you can grab that and follow along. And also, if you stick around to the very end of the video, as a thank you for sticking around, we're going to give you access to a coupon code that you can use to take a discount on this particular template at checkout as our thank you to you. All right, so before I dive in, just a little bit more background. So my name is Adam Huxama. I'm the co-founder of Projection Hub. We help small business owners create financial projections for all sorts of different industries. We have about 125 different industry-specific templates. In my background, I spent about 12 years as the executive director of an SBA lender. During my time there, we approved over 1,500 SBA loans. So I come to this work with that lender kind of focus, or that lender perspective, as we create projections. So hoping to really just walk you through this process and help you feel confident as you go and present to lenders and investors. All right, with that, let's go ahead and dive into how this template works. Okay, so I'm going to start here on the at a glance tab, and this is kind of the very end of the process. So after you've filled everything out in the model, you're going to have these nice graphs and charts and tables that you can pull into a business plan or a pitch deck. You're also going to get a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. So that's going to meet the SBA requirements, which require both annual and then broken down by month for your projections as well. So in order to produce these reports, though, we have a little bit of work to do. So we're going to go back to our input assumptions tab here and kind of walk through step by step. So the first thing you need to know is that any cell that's highlighted in light blue is an assumption that you can change without breaking anything in the model. So we're going to put our company name here, our projection start month. We're going to assume that this is for a startup, and so we're going to have a 0 starting cash balance. We're going to have 0 for our opening accounts receivable and accounts payable, 0 inventory, so kind of starting fresh here. Some of these assumptions can be important on the accounts receivable side. This can make a big impact on your cash flow. So what this means, average days sales outstanding, 15. This means how many days does it take to get paid after you provide the service? So we're saying on average here, it's going to take us 15 days to get paid after providing the pressure washing service. Now, if you're doing residential only, you're going to get paid up front, right? You should get paid when you provide the service. But if you're doing some commercial work, it's possible that, you might do the work, then you'd send an invoice. You might have, you might expect 15, 30 days for that accounts payable, system to process your payment, right? And so if you have a mix, let's say you have a mix of residential and commercial work, maybe your average is 15 days to get paid after providing the service. So that's what that assumption means. On the accounts payable, this is an assumption about how fast you pay your bills. So let's say, you fill up the truck with gas and you put on a credit card. Now you're going to have 30 days to pay that credit card after you have actually incurred the expense today when you filled up, but you have 30 days to pay. So again, this is kind of, we're saying, hey, on average, some expenses we'll pay with cash or upfront. Some things we might be able to put on a credit card and have that delay. And so maybe on average, again, it's a 15-day accounts payable cycle there. Inventory, this is just, initial inventory. So maybe cleaning supplies or just consumable supplies that you would need. And, this can vary depending on, how much. You may not need $5,000 to start off with, but let's just, for example's sake here, say we're going to buy a bulk amount here to start off with for our first handful of jobs. And then this average inventory value is a percentage of COGS, that's cost of goods sold. What I typically put in here is 10%, and this just means that we're going to keep a small percentage of inventory on the balance sheet. As we grow, that will scale with us, and so that's what I typically put there. All right, so I know I mentioned that this template is built for the ability to have multiple locations or multiple units of the business. So again, this first version, and I'll show you in a little bit how to do this with a multi-unit model, but we're just going to assume, hey, we've just got one location in this city one, and we're opening in month one of the model. And then we have an equity investment. So this could be your personal investment. This could be from outside investors. If you're getting an SBA loan, you're probably going to need to put at least 10% of the total project cost in as an investment. So let's say we've got equity investment. We can select the associated location. So again, right now we only have City 1 is the only location. So this investment is for this first location, $10,000. And we're going to have that happen in month one. All right, so on the fixed asset side, so the thought here, you're probably not going to have a whole lot in the way of fixed assets. You're going to have a bit of equipment, right? You're going to have the pressure washer and, tools, maybe some ladders, stuff like that, right? But that can be pretty minimal depending on, what kind of level of system you want to get. But so let's say we spend $3,000 on equipment to get started. And then I thought, maybe we have a small office and warehouse space just to store our equipment. Now this might be your garage when you're starting out, but let's say we're gonna do it at a little bit larger scale here, and we want to rent a space and kind of build out a warehouse space or storage space. And so let's say we spent $5,000 to kind of renovate the space that we're renting. So we have that here as leasehold improvements. Now if you don't have leasehold improvements, you can just put a 0 in there and you're good to go. We said purchase month is month one as well. So these are startup costs at the beginning of the model. All right, now we can enter in loans. So let's say we got a $40,000 SBA loan, maybe an SBA micro loan. When I worked at an SBA lender, we were an SBA micro lender, making a lot of these kind of less than $50,000 loans. So you can say we're closing that loan in month one. First payment's going to be due in month two. Can set an interest rate and a term in months. And now this green box down here is going to tell you here whether you have sufficient cash to open the location. So based on your assumptions so we're going to look at, what's the cost of the fixed assets, so the equipment and the leasehold improvements, how much working capital is going to be needed. So this is working capital is the money you're going to need to cover operating expenses while you ramp up and while you reach break even. So we've got some working capital need here. And then so our total cash needed just under $22,000. But we invested $10,000 of our own money plus borrowed $40,000. So we've got $50,000. We got plenty available here to cover those startup costs. So this box says, yes, you have sufficient cash to open the location. All right, so let's look at our revenue tab now. So the way this model is structured is really around your employees and your staffing, because the number of billable, technicians or cleaners or pressure washer staff that you have, that is going to drive your revenue, right? And so what we assume here is that you're going to hire 3 cleaners over a period of time. So we hire the first one in month 1, second in month 6, and then at the beginning of year 2, we hire our 3rd staff member. You can, continue to add more staff. You could hire multiple employees at one time if you wanted to. And then we have some assumptions down here for each of those individual, laborers or staff members. We have how many hours they're going to work per week. So we're saying they're going to work 40 hours. We're going to pay them $20 an hour. And we think they're going to be billable 90% of the time. So our goal is to get them to, billable 90% of their 40-hour work week is going to be, filled with work on a job. So they're going to have 36 hours a week of billable time. Our goal is to bill them out at $100 an hour. So as we think about how we price our jobs, you're going to have cost of materials, your cost of, travel time and that sort of thing. So, kind of think of all that cost that's going to go into it. And then ultimately, the way at least I think about pricing a job is like, what's that average billable rate that I'm hoping to be able to get? And so, I'm not necessarily prescribing that it has to be $100 an hour here, but I think what you'll see as you build out this model is that you can play around with this average billable rate and see, what do I need to charge here? What do I need my average billable rate on a job to be in order to break even or be profitable, right? And so we've got $100 kind of as a placeholder here to start with. All right, so then we can set the average number of hours per job, and this is really just for informational purposes. So the gray fields we don't need to change. These are just informational. It's just showing that the average number of jobs per week per employee would be 9, and then average revenue per job would be $400. So the base revenue per employee per week, it's just that 36 hours times $100 an hour, so $3,600. And we think it's going to take 3 months here for a new employee to kind of ramp up to that full capacity. So if we're saying 90% is their capacity limit, we think it's going to take 3 months after we hire them to kind of ramp them up and get them to that level. Then we can set a annual price increase. So this is going to drive that $100 an hour, up 3% over time to kind of stay steady with inflation. All right, so now we've got our cost of goods sold section here. So this is automatically pulling in the direct labor based on the assumptions above. So here's your per employee per month kind of wage cost here, and then their taxes and benefits. And we set that as 0.08 of their total kind of wages. So we have a little equation up here, but you can change that to whatever you want. But we're just multiplying their wages times 0.08 or 8%. And then for your job materials and your fuel, what we assume here is that if we come back up here and we think about the average revenue per job is going to be $400. And so if we put 10% of revenue, that means that for the average job, we're going to spend $40 worth of, material or like cleaning, chemicals, right, on the job. And then we also have fuel costs. So this is fuel for the job. Now this can be fuel for both the pressure washing unit, but fuel also for your vehicle to travel to the job site, right? And then we have an annual cost increase here for kind of the cost of goods sold as well. All right, so the rest of this is just calculations on this tab. All right, we're getting close to being done with this model, so thanks for sticking with me. This is your operating expense tab. So you can enter in some various operating expenses. You can set what category of expense you want them to be in. So you can actually create up to 10 categories up here. And then from this drop down, select which category you want to put them in. And then this is pretty useful here. So this cost driver, this allows you to make the expense a percentage of revenue, a per location fixed cost, or a corporate fixed cost. So let's start with percentage of revenue. Let's say we want to spend 5% of our revenue on advertising. And so that's just going to scale as the business grows. We're going to spend more on advertising because we have more staff to fill with work, right? And so we can set that, and that will just automatically grow. Now, if you have an accounting expense, for example, that might be, you might have an accounting expense for each new location that you open. Again, this is only one, we only have one location built into this template, but we're saying $500 per location. So if you were to add in future locations, this is automatically going to add another $500 a month for the second location, for the third location, and so on. Credit card processing fees, that's a good example of something that would be a percentage of revenue. And then we've got sales commissions, and then vehicle leasing. So, you could, back on this input assumptions tab, you could add a vehicle here as a fixed asset. So if you buy a vehicle and you wanted to add that in as part of your startup cost, and you actually, purchase the vehicle, you could do that here. The reason I don't tend to like to do the purchase of the vehicles in the model is because it doesn't scale very well. Each time you add a new staff or a new location, you need to add in additional vehicles that you're purchasing. Whereas if we kind of assume we're going to lease our vehicles, we can just say, okay, we're going to spend roughly 3% of revenue on vehicle leases. And we know, as revenue increases, we're going to need more vehicles. And so that just kind of scales automatically. All right, on the last input tab here, we just have our salaried labor. And so for the single location option, we're just assuming we're going to have just the salary for you, the owner. We've got a $50,000 salary, 8% employer taxes, benefits of 10% of the annual salary at $5,000. So you're going to get this kind of base level salary, plus you'll get the profit. If there's any additional profit at the end of the year, you get the profit of the business as well. So let's see where this kind of lands us. So based on those assumptions that we built in there, the first year you just break even. Second year, you're kind of fully ramped up. You've got 3 full-time cleaners at kind of that 90% capacity for the year. So you can kind of see you're up at that $100,000 net income level, and so on. So, all right, I want to take a quick peek over at the multi-unit version of this template. Okay, so here is our multi-unit version. It's the exact same template. We've just filled it out with some default data for multiple units to give you an example of what that would look like. So here we've got location 2 opening in month 13, location 3 opening at the beginning of year 3, month 25. Now here we're saying, okay, we're only gonna have this one investment for the first location, but then we're gonna have, for each location, we're gonna rent some space, have the leasehold improvements, maybe $3,000 for some renovations to a small storage space or something, and then some equipment costs. And then maybe we have some computers and software, at a corporate level here. And so with the computers, we don't have them associated with any specific location. It's kind of a corporate level cost. And then for the loans, we have a startup loan for the first location and a smaller one for the second location. But if we look down here at this green box, what we notice is that by the time we get to the third location opening in month 25, this will show us, how much cash is needed. And then this shows cash available from operations. So basically by this time, we have saved up enough cash from our profits that we don't even need to borrow anymore or invest anymore. We can just utilize the cash balance that we already have here. So that's how that works. Now, one thing to point out, when you have multiple locations, this is just going to follow that same pattern. So when you open the second location in month 13, it's going to assume in month 13 you hire one cleaner, and then you hire another cleaner 6 months later, right? So that's how that is expected to kind of follow that same pattern with each new location. This we've really already talked about. You can set per location expenses. And then there's just one little difference here on the salaries tab. We have a per location staff. So, let's say we still just have you as the owner, but maybe for each location that you open, you want to hire an admin person to help with sales, to help with invoicing, to help with, dispatching or just coordinating, maybe, any sort of paperwork or office type of work. Maybe you have an admin that you hire. at $35,000 a year. And we have this position starting in month 6 for each location. So when the first location opens, 6 months later, you're going to hire an admin for that location. When the second location opens, 6 months after that, you're going to have another admin for that location. So that's the way this section works. It is a per location staff. Whereas this corporate staff, it's just one owner, that's kind of supporting all of the different locations, right? Okay, so the main difference here, we can see, when we have over a period of time, 3 locations opening, you can see we're getting up to, 1.9 million in revenue by the end of year 5 with a healthy 19% net income, 362,000. So yeah, that's the process. That's why I wanted to show you. So if you've gone through this and you're like, you know what, I just want someone to fill this out for me, that is something we can certainly help with. We have a template fill out service, so feel free to reach out to us about that at support@projectionhub.com. Just email us and we will be happy to help you with that. And also, as a thank you for sticking around to the very end of the video, if you go into the description of the video below on YouTube, you will find a link to a form that you can fill out. So click that link, fill out the form. We are going to then be able to email you our discount code, our most up-to-date discount code that you can use at checkout to take a discount as our thank you to you for sticking around to the very end. And then my last request here, if you found this video to be useful at all, please like the video, subscribe to our channel so you can just help us help more folks learn how to create a set of financial projections for a pressure washing business. So we appreciate your support. If you have any questions, again, don't hesitate to reach out, support@projectionhub.com. Thanks.